studying your last two. I swim with tea when they turned in. The staring down to mute and can lend a pole that some kid died.
Consideration simply means what one party gives in exchange for receiving something else. In shareholder transactions, the key question is whether that consideration reflects the asset's fair market value. Fair market value, or FMV, is the price that an informed buyer and an informed seller would normally agree upon in an open market, with neither party being forced to complete the transaction. When a corporation transfers an asset to a shareholder and the shareholder pays its full fair market value, this is called adequate consideration. From the CRA's perspective, the transaction is generally treated as a normal commercial transaction. Problems arise when the shareholder pays less than the asset's fair market value. This is known as inadequate consideration. For example, imagine a house worth $900,000. If the shareholder pays the full $900,000, there is generally no issue. But if the same property is transferred for only $100, the shareholder has received a significant economic benefit. In these situations, the CRA may conclude that part of the value was transferred without proper payment and may treat the difference as a taxable shareholder benefit. So whenever a corporation transfers money, property, or any other asset to a shareholder or a related party, always begin with one simple question: was fair market value paid? If the answer is yes, the transaction is generally treated as normal. If the answer is no, the CRA may reassess the transaction and apply the shareholder benefit rules. Understanding the rules is much easier when we look at real-world examples of inadequate consideration. One common situation is when a corporation transfers property to a shareholder or a family member for a token amount, such as $1. Even though a legal sale has taken place, the selling price clearly does not reflect the property's fair market value. Another example is when a corporation owns a condominium or other property and allows a shareholder's child or family member to live there without paying market rent. In this case, the family receives a personal benefit while the corporation receives little or no consideration in return. The same principle applies when a corporate vehicle worth $40,000 is sold to a shareholder for only $5,000. The shareholder has received an economic advantage because they paid far less than the vehicle's actual market value. Similarly, if a corporation owns a cottage and the shareholder's family uses it for vacations without paying fair market rent, the CRA may consider the value of that personal use to be a taxable shareholder benefit. Another mistake is selling an asset at its original purchase price instead of its current market value. For example, a property purchased years ago for $575,000 may now be worth $1.2 million. Historical cost is not the same as fair market value, and using the old purchase price does not satisfy the CRA's requirements. These are all common red flags that attract CRA attention. Transactions involving family members, free use of corporate assets, below market sales, discounted rent, and transfers based on historical cost instead of current fair market value are all closely scrutinized. As a tax preparer, always think like a CRA auditor and ask one important question: what is the fair market value of this transaction? If the transaction is not something that two unrelated parties would reasonably agree to, there is a strong possibility that the CRA will challenge it and apply the shareholder benefit rules. When a shareholder receives corporate property for less than its fair market value, the tax consequences can be much more serious than many people expect. The CRA does not simply accept the amount shown on the sales agreement. Instead, it looks at the asset's actual fair market value to determine whether a shareholder has received an economic benefit. For example, Imagine a corporation transfers a property worth $1.2 million to a shareholder for just $1. Although the legal selling price is $1, the CRA will generally ignore that amount because it does not represent the property's true market value. Instead, the CRA will reassess the transaction using the fair market value of $1.2 million. The difference between the amount paid and the fair market value may be treated as a taxable shareholder benefit. Depending on the circumstances, the corporation may also have capital gains tax consequences. These reassessments often result in additional income tax, interest on unpaid taxes, and in some cases, penalties as well. Fortunately, these problems can usually be avoided by following a few best practices. Before transferring any corporate asset to a shareholder or a related party, obtain an independent valuation whenever appropriate. Prepare a written purchase agreement. Charge fair market rent for the use of corporate assets. Avoid discounted sales to family members. And maintain complete supporting documentation for every transaction. As a tax preparer, it is also helpful to ask yourself one practical question before approving any shareholder transaction. Would two unrelated strangers agree to this price under normal market conditions? If the answer is no, that transaction deserves a much closer review. The best practice is simple. Always start with fair market value. When transactions reflect commercial terms and are properly documented, the risk of shareholder benefit reassessments is significantly reduced.